All right. Good morning, everybody. Thanks for taking the time to join us for our webinar titled Opportunities for Long-Term Investors Amid Market Volatility. Um, I'm Nick Ryder, the Chief Investment Officer here at Cathmere Capital Management. And in today's webinar, what I really want to do is focus on what I'm viewing as some of the opportunities that are emerging from the volatility that's continued in markets over the last couple of weeks. So these are opportunities that we at Cathmere view are good ones for long-term investors who are able to tune out the negative headlines and the day-to-day noise in the markets, and really focusing on achieving your long-term investment goals. I heard the analogy the other day, which I thought was appropriate, likening this as rain showers and rainbows. So we've obviously had some painful moments in the markets in the last couple of weeks and in our portfolios amid the volatility. However, as following a lot of rainstorms, you get a rainbow. And we think of that as the opportunity and some good things emerging for investors who are able to have the fortitude and the patience to ride out the proverbial storm here. So we'll start an update to a slide we shared in the webinar. I guess it was a little over 2 weeks ago at this juncture, but here just presenting the S&P 500 index. We can see that from its all-time high that was achieved on, amazing to believe it wasn't all that long ago, on February 19th. We saw the market as of the close on Monday, March 23rd. Market was down nearly 34% from its high in a very swift and rapid decline, which we'd covered before. We had a nice little rebound last week. Actually, the rally from Tuesday to Thursday was the strongest 3-day stretch we had seen in markets since the 1930s. All told, the market was up some more than 15% during that 3-day stretch. We've had a little bit of choppiness and given a bit back since then. And you can see the market as of 2 days ago, closed down 27% from its all-time high. What we want to do, though, focus, as I said, the opportunities for long-term investors. I don't want to dwell on the certainly painful declines we've experienced, but instead, let's take a look forward, and we see some opportunities emerging. So, for us, we think future returns look better. We can see, that. As I mentioned, this is a decline of more than 30%. This is now the 6th time since the end of World War II in which we've seen the S&P 500 decline by 30% or more. What we see on this slide, looking back at each of the past 5 instances, we can see the date of the market peak in the furthest left-hand column. Second column shows the date where we were first crossed that threshold of declining by 30% or more. And ultimately, we can see that in each of the previous 5 instances in World II, and if we were to expand even further, the same would apply here, is that the market has recovered. It has reclaimed its prior peak. And what we can see on the far right-hand side of the screen is how often or how quickly it takes from that 30% drawdown threshold until we've reached a new high in the market. We can see at the bottom right-hand side of the screen, on average, it's taken roughly 4 years for the market from the day it's crossed the 30% drawdown until it's reached a new high, but you see a decent amount of variability around that average. Of course, we've seen that in 2 instances, the market's recovered in less than 2 years, and you've seen it extend out as long as 6 years in what we see in the instance of the declines in the mid to late part of the 1970s. But you also see the early part of the 70s, a quick rapid decline as well, or recovery, as well as in the late 80s as well. Assuming that the market recovers, and I as an optimist at heart and believe that this time will be no different than the others, and that the market will recover, that we will get our hands around this virus, contain its spread, the economy will rebound on the backs of the combined efforts from policymakers on the monetary side, which we covered last week, as well as the fiscal package. We believe markets will recover. For me, in my perspective and our perspective here at Cathmere, it's less of a matter of if, but rather when will the market recover. And what we show here on this page, which is fairly hypothetical, believing the market recovers as it has in the past, future returns look bright, particularly if you compare them to alternatives out there. Namely, if you were to talk about Treasury bonds, for instance, or money in a bank account. Treasury bonds now, the 10-year Treasury is yielding less than 1%. If we believe that the market is to reclaim its all-time high in 2 years, in order to get there, we'd have to see a 17% per year advance. If we think it's going to take the average amount of time we saw on the previous page, that's still an impressive 8% a year to get there. Even if you were to stretch it out and say, I believe this is going to be a long, drawn-out recovery, and it's going to take 6 or 7 years for the market to fully recover its highs from just 6 weeks ago, you're still looking at 5% a year. That's on a price-only basis. If you add in a roughly 2% or so dividend yield, you can see those numbers start to look quite strong and attractive for long-term investors. This slide should look familiar to many. We included in the webinar 2 weeks ago. And what we're looking at here is the valuation of the U.S. stock market as measured by the S&P 500. And just a reminder, this is maybe a different measure than many of you are accustomed to seeing, whether it's in the Wall Street Journal or on CNBC. This is what's called the Shiller price-to-earnings ratio, or in a much more tongue twister is the cyclically adjusted price-to-earnings ratio. For short, we call it the CAPE. And what this is, it compares the price of the S&P 500 index to the earnings over the last 10 years adjusted for inflation. And this is probably my preferred valuation metric, as it tends to remove some of the quarter-to-quarter, year-to-year noise in earnings. If we were to look at other commonly cited metrics, whether it's the price to next year's earnings or last year's earnings, so a forward or trailing PE, they tell a similar story today, which is that valuations have come in much more, as a result of the sell-off, valuations today are much more attractive than they were even 6 to 8 weeks ago. What we can see over here on the right-hand side, and we plot the CAPE going back all the way to December 25, you can see the ratio rests at 23 using the close of the market on 2 days ago on April 1st. And you can see what we also plot on here is the full period average, so stretching over 90 years here. That level is averaged at 18.2. We limited this the last 15 years, it's 20.4. And if you focus even more on the more recent experience, that average has been 27.3. So depending how you look at it, valuations, again, far more inexpensively valued today than they were 6 weeks ago. And if you're comparing the last 25 years, now look cheap. If we look over the last 50 years, maybe still slightly above normal. I think there's plenty of reason to believe that an average or neutral valuation range today is arguably and should be higher than it has been over the whole history. Whether or not the last 25 or the last 50 is more representative, we could debate. But nevertheless, I look at stocks and say they're more attractively valued today than they were in the past. That's a factual statement, not getting into an under or overvalued comment, which is then a whole nother animal. But nevertheless, why is this important that stocks are more attractively valued today than in the past? And this is something we've talked about in the past, which is that starting valuations for stocks and their future returns over the longer term, but now here we're measuring 10-year returns, have been strongly linked in the past. And it's been an inverse relationship whereby low valuations have been associated with high future returns, and conversely, higher valuations have been related or linked with lower future returns. And so what we see on the chart here is along the left-hand side, and what's the green line throughout the chart is the CAPE ratio. So what we saw on the previous page, the valuation metric. And note, please, this is an inverted axis so that cheaper valuations are presented at the top of the screen, lower or more expensive, higher valuations at the bottom of the screen. But you can see the valuation metric has, as we saw on the previous page, bounced around over the last 90 plus years. What we also overlay on this chart now is in purple, and it's measured now on the right-hand side of the screen, taking a valuation level, what did the market end up returning over the subsequent 10 years? And so the last data point you'll see here is dating back 10 years ago through March of 2010. And you can see that we saw stocks return about 12% a year from March of 2010 to March of 2020. We can see this throughout time. And what we see is these charts overlay pretty well with one another. And that periods with low or attractive valuations, notably through the mid part of the 40s, coming out of World War II, you saw very inexpensive valuations and very high future returns for the S&P, north of 20% annualized. We see some similar experience coming back to the early 90s, or excuse me, if we look into the mid 80s, where you saw again low valuations, high future returns. On the flip side, we've seen another period where valuations have been more richly valued, even into the late, or I'll really focus here on the dot-com bubble, where you saw valuations at historic highs. And what did we see then for the first 10 years of the 2000s? We saw what was the lost decade, where S&P had basically flat to slightly negative returns from 2000 to 2010. So that's why we think valuations are attractive. What it does, and you can kind of see it hidden here on the right-hand side of the screen, is that as a result of cheapening valuations, our future return expectations over the next 10 years are now higher. Depending on the precise way we look at this, we think that today the most recent decline boosts our 10-year forward-looking expectations by somewhere in the range of 3% per year over the next decade. Vanguard actually put out a chart 2 weeks ago that reinforces this message, and that basically saying that the long-term outlook has improved as a result of declining returns recently. This was, you can see, through March 12th, but Vanguard here showing from their capital markets model, which simulates returns over the following 10 years. What they show here is kind of the range of forecasts their model would have told them over time through the 80s and into recently, on what we could expect from markets, and then also overlaying it with trailing 10-year returns. And so you can see as returns have fallen considerably in the last 6 weeks over the last 10 years, as those returns have come down, what they've shown is that their forward-looking expectations for markets have increased. And you can see that based on their model coming into the year, they were assuming the U.S. equity market would average 4.4% a year over the subsequent 10 years. Just after the most recent decline, that forecast has been revised upwards by nearly 2.5%. And I think if you were to look at it today, it would be a little bit higher as well, as markets are a touch below where they were on March 12th. So some good news there, which is that, hey, we've lived through this rain shower. It's not been pleasant for a variety of reasons. However, the rainbow in this, or the positive outlook, is that our forward-looking expectations are now higher as a result. Much more, I'll call it normal-looking simulations if we think out over the next 10 years relative to what we were talking about coming into this year, which is that investors should be bracing for below average returns of the coming decade. This slide here broadens our scope of analysis here, and we're going to bring in valuations on developed markets, developed markets excluding the U.S. as well as emerging markets. And you can see that valuations across the board have fallen, right? We just talked about the U.S., but we can see a very wide gap has now emerged, and you look at the valuation levels on developed markets in the blue line, and emerging markets are extremely attractive now. I've been talking around the office that these are the types of levels where I think that long-term investors that are able to have a greater than 5-10-year horizon should start to get pretty excited about. We can see that in the case of developed markets, their valuation levels approaching basically that which we saw during the depths of the financial crisis. For emerging markets, we're down up close to a 10 on the CAPE ratio, which a level we really have not seen since, so you can look on the chart, going back to 2003. If we look at this, I just pulled a couple of returns this morning and said, all right, what did these various indexes do from 2003 over the subsequent 4 years, really before the financial crisis took hold? And we saw emerging markets from 12/31 of 03, so from the beginning of 2004 until the end of 2007, emerging markets were up 189%. That was 30% a year. And that compares quite favorably to still strong returns for developed markets, which were more expensively valued, but still, relatively attractive at that time. They went on to return 86% over the time period, so 17% a year, which is contrasted to EM's 30% a year. And you saw U.S. stocks still slightly more expensive than their developed market peers, deliver a still healthy 9% a year for a cumulative gain of 41. But we did see this period when you had a pretty wide valuation gap. These things that were really cheap had an awesome return experience over the relatively near future. Of course, I have no idea what's going to happen in the months ahead, even the year ahead. But what we do know is that these types of attractive valuation levels have been in the past associated with pretty strong forward-looking returns. I'll also point out here a couple other things on the chart, which is that we see that U.S. markets aren't always the most expensively valued. It's not as though the U.S. market commands some valuation premium. We've seen episodes in the past where, you can look going into the financial crisis, international stocks had a great run through the early part of the 2000s while U.S. stocks languished. They became more expensively valued, and what have we seen over the subsequent 10, 12 years now? U.S. really lead the way. Another episode where you saw international become way more richly valued was the late 80s, and this is really when it was widely assumed that Japan would kind of take over the world with their management and operating prowess and efficiency of their factories and outputs. They became exorbitantly valued, and what you saw then really throughout the 90s was that U.S. market, starting with a much more attractive valuation level, dominated international markets through the course of the 2000s. So this is a cycle we've seen play out before. Exactly how it's going to evolve and unfold remains to be unknown. Nobody has a crystal ball and is able to predict that, but we do say that historically, again, starting from attractive valuation levels like what we see, investors have been rewarded. Another thing, a common refrain I hear from this with conversations with investors of all stripes is that basically, hey, we're gonna, international companies just aren't as good as the U.S. markets, and I don't want to invest in those. And generally, it kind of boils down to a variety of different themes that we hear. One is that it can center on economic political systems. Hey, they're much more socialistic, particularly in Europe, and less market-oriented or less of a capitalistic society than we are. So their companies aren't going to be as attractive to invest in. As a result of that, a follow-on could be economic outlook, which is partially related to the political views. Could also be to, hey, elevated debt levels in Europe, aging population around the globe, less likely to have as dynamic of a growth outlook. The other part, management efficiency, corporate growth, profitability. That, hey, they're somewhat related to the above, but just their companies aren't as well run as they are in America. They're not going to grow as well. They're not going to be as profitable. And I think, look, as a general rule, those are all very valid, strong points. We've seen over the last handful of years, U.S. companies have been more dynamic. They've been more profitable. They've grown faster. If you think about just a lot of the companies that are being touted as the companies of the quote-unquote future, it's mostly centered on these tech companies, which by and large are U.S. companies. Again, no pushback on that. Those are factual statements that I totally agree with. The question really, though, in my mind, and what investors should be concerned with is not whether the U.S. companies are inherently better than their international developed market or EM counterparts, but rather, has this really been sufficiently captured in market prices yet? Legendary or famed investor Howard Marks, the founder of Oaktree Capital Management, he often writes about and talks about what he calls a distinction between first-level thinking and second-level thinking. And in first-level thinking would go, basically, the line would be, hey, U.S. companies are better than their international peers, therefore let's buy them. In Marx's view, the trait of a great investor and what they try to practice at Oaktree and have had tons of success with is second-level thinking, as he describes it, which is, hey, U.S. companies are better than their international peers. But everybody knows that, and it's already incorporated into the price. And he says, in fact, basically it's possible that it's been overdone, such that international stocks have been too far beaten down, that the valuations are so attractive that they don't need to be better than U.S. companies going forward. They just need to be slightly better than the terrible expectations that are already embedded in their prices. Whether or not that it's sufficiently embedded, I don't know. What we can see is pretty factually is that there is a valuation gap that has emerged and starts to provide some opportunity, we think, again, for long-term investors. Slide 8 here, there's a lot going on here. I'm not going to go through it in detail, but basically looking at the data that we showed 2 slides ago where we said lower starting valuations are associated with high future returns for U.S. markets. That relationship isn't just limited to U.S. markets. Here this is a chart from a research provider called Research Affiliates that runs a similar analysis, including a variety of, call it 10 or so other companies, and said basically plot starting valuation levels and future returns over a variety of time frames. And we can see here's a line for U.S., which would be what's called a regression line. And we see starting valuations in the U.S. market, high future returns. High starting valuations, low future returns. And we can see overlaid on here are lines for Canada, France, Germany, Hong Kong, Italy, variety of other countries around the world. You know, the exact slope of the line, the exact shape it takes differs across these companies, but nevertheless, we see a very clear downward sloping relationship, which means low valuations in the past have been associated with high future returns, high starting valuations, lower future returns. So we look again, just a little bit of an additional validation to what we've been talking about here with valuations being more attractive is a good thing for us as long-term investors. I'll turn back again to just U.S. data to emphasize this point further and to show what I think and why I start to get pretty excited about where valuations are for international developed and emerging markets. And what I showed 2 pages ago, we saw developed markets trading at a CAPE ratio of somewhere in the range of 12, 13, EM even more attractively valued, closer to 10. This is a chart from another asset manager called GMO. They looked at instances in the past of buying the U.S. market at a CAPE ratio of 13. And they followed it then through subsequent 1, 3, 5, 10 years. And going back basically as far as they had data on. And what you can see as we look through this chart, 1 year, 3 year, 5 year, 10-year returns, quite attractive when you start buying markets at a valuation level similar to that of what we're seeing in developed and emerging markets. And you can see on average, you look out a year after it's been up more than 15, nearly 20%. 3 years later, you've eclipsed 60% on average. 5 years after, 100% on average. 10 years, even more impressive, starting to look at returns north of 250 to 300% on average across these. Of course, there's a variability in here. And of course, it's possible that, as the saying is, that cheap can get cheaper, that things don't necessarily have to move in your direction immediately when you buy things cheap. And you can see there were a couple instances during the early part of the 20th century and in through the Great Depression and even to the 40s where you bought the market at a cheap level and it continued to get cheaper. Eventually the market troughed and rebounded, and you can see even in these instances where you had significant immediate declines, the longer term returns still were attractive. We really cut the analysis and focus really since the post-World War II era. Even more impressive we've seen longer, and some of these results get pretty attractive for long-term investors. So that's the longer-term outlook. You know, another common concern I've heard voiced from a variety of investors in recent weeks is that hey, the economic data, well, hey, the last 2 days or yesterday we saw some bad data even in terms of the unemployment claims. A week ago we saw very bad data as well. So the economic data is starting to get bad, but a lot of people are saying, hey, the economic data is just now starting to look bad and it's sure to get worse, right? We're only a couple weeks into the shutdown. Unemployment still hasn't spiked. Of course, we did see 3.2 million job losses 2 weeks ago. Our initial claims for unemployment, we saw another 6.6 million, which are just enormous numbers. In the heart goes out to everybody experiencing that right now. And but we're starting to see that bad data. Many people are saying, hey, the data is only going to get worse. We haven't seen the massive hit to corporate profitability. We haven't seen how bad second quarter GDP is going to be. You've seen forecasts out there from the various banks and forecasters, some saying that GDP could decline at an annualized pace of north of 20 during the second quarter. All absolutely true factual statements, right? The economic data is sure to get worse. What we want to point out here on this slide, though, is this reminder, and we've touched on this last couple of webcasts, but the stock market and the economy are the same thing. As we've talked about, the market is forward-looking. It leads the economy on these things. And so what we're comparing here Chart on the top shows monthly performance of the S&P 500 index. The bottom shows monthly change in non-farm payrolls. And what we focus here is on the 3-year stretch around the financial crisis, starting back in September of '07. And I just highlight 2 periods on here to show kind of the forward-looking nature of markets. We can see as we look in late 2007 and into January of '08, while the economy was still humming around, we were still seeing positive job gains. This is really when the market started to get concerned about what was going to happen to the health of the financial sector, and ultimately starting to predict or price in a recession. You saw a couple of months of declines, market down by north of 10-12% during that period. Then really the job losses started in earnest. However, what we see right through the depths of the financial crisis here, with these really terrible months for the market, as the market's declining though, we got ourselves to the point where the market eventually bottomed out in March of 2009. Right, we saw this historic, very strong bounce, up 9% in March, up nearly 10% in April, up 6% or so in May. Interesting, what people forget is that the economic news was still coming in quite bad at that time. It's just that the market started to say, yes, we are going to turn the corner on this. All the bad news has been sufficiently priced in. Things are now getting better than what we expected. And so what you see here is that, right, March of '09, market was up 9%, but you saw 800,000 job losses. April of '09, market's up 10%. You saw 700,000 job losses. Another 342 in May. All the while, the market is starting to rally much strongly higher. Again, I've made this point before, which is the question isn't about whether or not the data is going to come in bad. Nobody's debating that. The question is, has the bad outcome been sufficiently priced in? Has the 30% drawdown in markets accounted for the fact that all these bad things are going to happen? Turn here now is just saying, or taking an examination of what happens when you buy stocks, or how have stocks historically fared if they were purchased immediately following the day where they were down by 30%. So, the question, what we look at here, and what I'm trying to highlight is a common refrain I get from people is, yeah, I believe the market's going to be higher in the future. I believe the recovery is going to come. But what if things get worse? And so what we're looking at here is, again, those same 5 prior instances where the market declined by 30% or more. This was from the second slide in the presentation. Date of the market peak. We'll look at when the 30% drawdown was realized. And then basically say, if I bought the next day, so in this case, this would have been buying 2 weeks, a week and a half ago. How did markets fare over the following 1 year, 2 year, 3, 5, 10 years from that date? You can see, generally speaking, markets a year later, 2 years, 3 years, have been up. On average, we've been up by a little bit more than 10 a year after the fact, 25, 2 years, and 3 years after the fact, and even more so if you extend the horizon out 5, 10. What I also highlight, or what I'm adding to this chart now, is in a number of these instances, the market did decline first. We saw, if you bought the day the market went down by 30% or more, which was July 5th, 1974, market still went down another 25% from there. We saw a total decline of 48. Amazingly, though, or shockingly maybe to many, is that a year later, from July 5th, you were up by nearly 12%. 2 years after the fact, up by 24%. 87 was a different example. Basically, the market didn't decline a whole lot more, and it rebounded sharply. 2001 really kind of stands out more than anything here as the anomaly. We had a much more slower recovery. The market took a lot further time to bottom out. This was, though, in my perspective, more of a unique scenario in that you started with extremely high valuations. There was more of an adjustment to that than it was really truly an economic crisis or a recession. So you had a slower decline that tended to grind out longer, but yeah, you did have another 25% down. A year later, you're still down, unfortunately. 2 years, you're basically broken even, and you can see even in the 3, 5 years, the recovery is slower, and then the 10-year dropped off a bit because you started to include the financial crisis. If you look at the '08 period, you could have bought in October of '08. You saw another gut-wrenching 36% decline from there. But amazingly, after the strong recovery from the March of '09 bottom that we showed on the previous page, you're basically break even a year later, up 10, 2 years, and 3 years later, and then really, as we saw the past bull market, even a sharper rebound in the subsequent years. So I don't know what the future holds. I don't know if we're in for another 10, 20, 25% decline. I do know that history is on our side if we say that now is as good as buying opportunity as any. That if we look out and extend our horizon, as many of us have, is a long-term horizon with our stock assets, as we should, that the future is bright for us. That there are some rainbows for us to be focusing on here, and that 2, 3, 5 years down the road, we are far more likely to be higher than where we are today. This slide, just to extend that refrain a little bit further, or some of the comments and questions we've been getting from our clients and other investors, is that, yep, I get it. Markets are likely to be higher 2 and 3 years ahead, but you just showed me that there are instances where market declines another 20, 25, 30%. I'm not prepared for that. Or, simply, I think there's going to be a better buying opportunity in the future. I've got cash, but I'm not quite ready to go back in. What I want to, this is really a quote unquote timing the bottom type strategy. We've talked, we here at Cathman, we tend to reject the notion of timing the bottom as a flawed strategy. And that's because twofold. One, the bottom doesn't loudly announce itself. In March of 2009, there wasn't a bell ringing. There was no headline that said the bottom is here, everybody, it's time to go in. The markets are about to start to move higher, right? We showed there were 900,000 job losses in March of 2009. News was still pretty bad. What ends up happening is psychology starts to take hold and say, yep, things are bad enough, but the picture is getting brighter. And the other reality in why we express some concern about this timing the bottom strategy is that it can be costly in terms of lost opportunity or missed returns. What we look at here is, again, these same 5 market declines of 30% or more. Now focus on the bottom. So here's the March of 2009 bottom, and going backwards. How did markets do in the 1, 2, 3, 6, and 12 months after hitting that bottom? You can see historically in many of these episodes, the rebound was sharp and swift. On average, just a month after the bottom, markets are up 15%. They've kind of held steady on average, in the following month, but you start to extend that horizon. Missed the bottom by 3 months. On average, you've missed 21% of returns. It was even more significant in March of 2009. You missed 40% of returns if you were just 3 months late. If you were 6 months late, you missed a 52% gain. So there's real risk in our perspective of trying to nail the bottom. And just because, as we show here, if you're a little bit late, you've missed a lot of opportunity. You may end up being kind of caught behind it. In the last slide, I'll just conclude here with, if you turn on CNBC or any of the financial news networks, you read any columnist in a newspaper about investing, and there's a similar theme that just seems to be pounded all the time on these shows, which is now's the time to be really discerning with your investments. It's diversification doesn't need to play a role. It's time to get quote unquote active. Really focus your investments, and forgive me, you've probably all heard this, which is, hey, it's time to sharpen our pencils. Let's identify the good, strong, high quality, profitable companies, those with strong balance sheets that aren't, in these industries that are really being hit hard. So stay away from the retailers, the energy companies, et cetera, the financials. Instead, let's focus on these real ballast type companies. Those are that are going to be positioned to ride out this crisis well, right? Dump all those other troubled industries. Basically, focus in on a small pool of kind of high quality and et cetera. And basically, the implicit logic here is that it's time for quote unquote active management, right? Fortunately, we can in many respects empirically test this claim, which is that are bear markets a time when it really does pay to be active and to really eschew diversification and focus in on more fundamental analysis that's kind of traditional active management. And so what we look at here in similar claims, you go back and read articles, commentary, et cetera, from during the 01-03 bear market or during the financial crisis. And the specifics were different. Right in 01-03, it was avoid the tech, media, telecom companies. Right in the bear market, it was avoid the financials, and again focus on the consumer staples, the healthcare. These companies that are going to ride it all out well. what we look at here, though, is we can test, did active managers outperform coming out of those past crises? And so what we look at on this slide is, hypothetical example of investing either in equity hedge funds or global stocks. As of for each of these bear markets, we choose 2 different dates. One, what we see across the top, will be invest during the first month following the decline of 30% or more. So in this case, it would be basically investing today or yesterday at the beginning of April. We crossed 30% last month, invest now. In the case of the 01 market, it would have been invest on October of 01 or invest in November of 08. And the other part would be invest really the first month following the market bottoms. This could have been April 03 or March of 09 and ride it on the up. Bear in mind, when we talk about equity hedge funds, these are run by the best and brightest out there, right? These are extremely sharp, knowledgeable, well-studied, well-versed investors. They're very well incentivized to do well. A lot of the main economic incentive or driver in a hedge fund world is from what's called carry or performance fees. So basically, these managers share handsomely and can be very, very richly rewarded by doing well for their investors. And the other important part here is they have the full toolkit at their disposal to make money. They can profit not only from believing or betting that market sector specific companies are going to go up. They can do it with leverage, so they can enhance the return on that. The other side is they can profit if the weaklings, so the market as a whole, the sectors as a whole, or the specific companies go down, they can bet against them and make money that way. So they should theoretically, if this claim that active management is the way to go in these bear markets, hedge funds should be the best place that should really benefit from it. And what we see is the data just does not validate that claim. So if we look at the 01-03 bear market, invest in October of 01, and you can see that the green line is going to be global stocks. The gray line is going to be the hedge funds. You can see that the hedge funds held up a little bit better. As a reminder, this was a bit of a long, drawn-out kind of bear market. They held up a little better. But once the market started to recover, and here if you invested at the bottom, it wasn't even close. From that bottom, from the date things turned, global stocks as a whole just absolutely trounced equity hedge funds. And you can see if you take the whole 5-year history or a 5-year performance, investing $100 in equity hedge funds from October of 01 through the end of September of 06, you ended up quite a little bit ahead in the hedge funds. The 08-09 financial crisis bear market tells the story comparably, but even more dramatically. Invest in November of 08 into equity hedge funds. And yeah, you held up a little bit better for the first few months. But really, once you hit March of 09 and the market started rebounding sharply, the rising tide lifted all boats. And what you saw was the global stocks kind of took off. And at the end, $100 invested was 188 versus 145 in hedge funds. Take that from the March of 09 bottom, and the result's even more dramatic. So what we see here is just empirically speaking that these claims or the logic that we have to get active. We got to really, really, really focus on the good, high-quality companies and eschew those bad ones, or that it's somehow easy to identify who the future winners and who the future losers. It's a flawed strategy in our perspective. We still think that the principles of keeping costs low, make sure we're capturing market rewards via traditional indexing or factor tilting strategies between employee and client portfolios still holds as much validity today as it does over the long haul. So with that, I'll kind of wrap things up. I know I've gone on for about 40 minutes now. I apologize. I get a little, as you can tell, enthusiastic and excited about all this. I'll wrap things up with, as I have in the last couple of webinars, I'm an optimist at heart. I truly believe the economy and the markets are going to recover from this episode as we have in the past, right? As in the history of U.S. markets, we've lived through 2 world wars, various previous pandemics, episodes of hyperinflation where inflation was running north of 15-20%, super high interest rates, the terrorist attacks, the global financial crisis. The market has experienced these things. Markets have declined, but they've recovered each and every time. I do not believe this is going to be an exception to that. We will recover. Again, things might get worse before they get better. I cannot sit here with any confidence and say that that markets won't decline another 10, 20, even more %. But I do believe that for us, like all of you out there with a long horizon for your equity market investments, the markets will recover. We will capture those rewards on the way up. It's also possible things don't get worse as well. It's possible that we've hit the bottom and the bottom will come. And lastly, even if a decline does come, again, I'll reinforce this point of we don't think waiting for the quote unquote bottom is the right strategy. We think it's risky. It's potentially costly, as I showed with that data of how quickly markets can bounce off the bottom. I reframed the question a little bit. It's not whether now is the best time to invest. We can only identify that in hindsight. The question to me, or the more relevant one for investors, is it a good one? Is it a good time to invest? And I hope that the data we've shared today says, yes, it is. Whether it's looking at 30% declines, historically we've done well. Whether it's looking at valuation levels, historically buying at valuations levels like what we're seeing today have been rewarded and been a good endeavor for investors. I think this time is going to be no different than in the past. I believe now's a good time to invest, and we look forward to working with you all and helping you, through this process. So, as always, if you have any questions or comments on what we covered today, please do not hesitate to contact me directly, contact your advisor, and we can certainly chat further about all this. Thanks again for listening, and we'll talk to you soon.